Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now we've had a fairly dramatic start to the month of October with sort of the extremes of good news and bad news. On one hand, of course, we witnessed escalating tensions in the Middle East, which arguably has coincided with a cautious tone in global equity and bond markets. At the other extreme, of course, we Chinese equities staged a notable rally following what were some fairly significant policy announcements in the market. Now, overall, what does this mean for investors, and how can they consider positioning following these news and events? To help make sense of that, I'm joined by Raymond Cheng, who's our Chief Investment Officer for North Asia. So, welcome, Raymond. Thanks for joining us today. Let's start with the divergence in market trends between US markets and Chinese markets. What's really driving that, and what do you see as the main investment implications?
Thanks, Manpreet. From September 24th onwards, China surprised the market with a comprehensive policy stimulus package. The package covered monetary easing, housing rescue measures, and funding to boost stock market sentiment, among others. This spurred a lot of fund inflow into China equities at a time when valuations there was quite cheap, and investor positioning in Chinese stocks was extremely light. So, going forward, a longer-term stock market upturn will likely require a sustained revival in economic growth and the property market in China. This, in turn, potentially requires a fiscal spending boost that should be significantly higher than the 1 to 2% range of GDP currently anticipated by the market. Now, in comparison, the last major fiscal policy stimulus back in years 2015 to 16, which resulted in an 18% trough to peak stock market rally, entailed a 10 percentage point boost of GDP in terms of cumulative net government borrowing. Now, there's also the risk of trade tensions with the US, especially if former President Trump returns to power. Now, given this, we maintain an overall allocation to China equities that would be in line with global equity benchmarks. Now, on the other hand, US equities seem to be in a consolidation mode. Now, this was partly because the 10-year US government bond yield ticked up slightly to over 3.8% in reaction to better private sector job opening print. Another key factor was the escalation of the Middle East tensions, which raises the chance of accidents, thereby causing the risk premium and oil prices to go up. However, we see limited long-term market impact from the escalation unless Iran's oil installations are attacked. Now, the US administration certainly has little incentive to disrupt Iran's oil supplies and risk higher oil prices heading into the November presidential elections, given the ongoing battle to tame inflationary pressures. That said, investors that are looking to hedge against any short-term energy shock can consider gold and energy sector equities and bonds. The next key data to monitor would be the September job market report, CPI print, and 3Q corporate earnings releases that would begin in the following week. The U.S. stocks will need the resilient September job market report and Q3 earnings beat that is substantially better than consensus earnings to sustain this year's rally in the coming weeks.
Thanks, Raymond. I wanted to circle back to Chinese equities because one question, I guess, front and center for investors is the rally still worth chasing or is it too late? And is there any color in your mind in terms of index levels?
The steep rally over the past week and a half has been due to a large degree the fear of missing out by global investors in China equities. This was understandable because prior to the stimulus measure announcement last week, a global investor survey showed that over a quarter of the global funds had zero exposure to Chinese equities. Now, this explains why during the past week, when mainland investors were on the National Day holiday, the Hong Kong stock market still enjoyed record high trading volumes. For Chinese equities to move sustainably higher in the long run, the participation of mainland investors after the National Day holiday is critical. Now, if fiscal stimulus measures come in stronger than the market's 2 trillion yuan expectation, the Hang Seng Index will likely sustainably get to our bull case scenario range of 22,500 to 24,500. Should the fiscal support come in later or smaller in magnitude than expectations, the index will likely pull back to a near-term bear case scenario range of 18,000 to 20,000. So all in all, valuation levels are still reasonable for Chinese equities. Our preferred sectors of consumer discretionary and communication services offer opportunities for rotation into laggards. Alternatively, the energy sector within our preferred non-bank high dividend yielding state-owned enterprises opportunistic buy idea is also likely to benefit from ongoing tensions in the Middle East.
Okay. I want to also get your thoughts on the CNH because unlike equities, the CNH did see some initial strength, but that to some degree has reversed. In the context of the policy stimulus, what's your view on the currency?
The policy announcements should be quite supportive of the CNH, but we think that the markets have two key concerns in mind. The first one is that further fiscal stimulus will be required to support domestic consumer confidence. The second factor is that a Trump win in the US presidential elections will likely lift concerns about a surge in tariffs on Chinese exports. Now, more trade tariffs and or sanctions will likely pose downside risk to the CNH. Therefore, we believe, unlike equities, CNH strength will likely be capped. Technically, the dollar CNH momentum indicator is already sending a gradually more bullish signal, indicating potential upward pressure and a likely test of the next resistance level at 7.136. Meanwhile, we think support will likely stay at around 6.971.
All right. So moving elsewhere to North Asia, I suppose we have a new prime minister in Japan. How do you see that impacting the outlook for the Japanese yen?
Following PM Ishiba's comment that Japan's economy is not ready for further increases in interest rates, the dollar-yen pair bet losses and rose 2%. While sensitivity to his comments may be high in the near term, we view interest rate differentials between the two currencies as the key long-term fundamental driver. The US-Japan interest rate spread is still narrowing amid expectations of the Fed's rate cuts. Meanwhile, Japan's inflation has been resilient, the labor market there has been strong, and real household income growth has been sustainably rising since the end of last year. So on balance, we expect the dollar-yen to trade in a range within 140 to 149 over the coming months. Now, over a longer 6 to 12 month horizon, rate differentials will likely argue for a fall below this range to 135.
Okay, and finally, markets have been fairly immune thus far to geopolitical risks in the Middle East. Do you see a scenario where that could change?
Given the intensifying tensions in the Middle East, oil prices have proven to be the key channel of transmission to financial markets. So we think that investors who are looking for a short-term hedge against oil price shock or intensified geopolitical risk, may consider the U.S. energy sector equities given the correlation with oil prices. Now, more broadly, current risks are consistent with our asset allocation view with an overweight stance on gold. Also, higher quality bonds, in particular U.S. Treasuries, should also do well in an environment of rising volatility. Equities may likely face the most volatility in this environment, but for long-term investors, this will likely provide a good opportunity to add exposure if the U.S. economy ultimately remains on a soft landing path as per our base case suggests. So Chinese equities also offer an opportunity to diversify sources of returns, given the market is currently more focused on domestic policy drivers.
Okay, well, thanks very much, Raymond. I think we're about out of time, so we'll bring the conversation to an end there. If I can sum up the key takeaways from today's chat, number one, of course, Chinese equities may have a little bit further to run in the short term, but we'd watch for more stimulus on the fiscal side to signal greater long-term sustainability. Second, of course, the Japanese yen. We expect it to trade in a relatively wide range in the short term. And finally, of course, our base case might be that geopolitical risk remains contained, but the energy sector, of course, could offer one attractive hedge against an escalation. So with that, Raymond, I want to thank you for your time today for joining us. And thank you, listeners, for joining us for today's conversation. We hope you found that insightful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.